For years and years, Wall Street never had any confidence in the gold rally, continue to expect the price of gold to crash. But I think the investors are now starting to come to the conclusion that gold ain't going down. In fact, they're going to have to get used to the fact that it's going to keep going up. I continue to strongly recommend. I think the consolidation is coming near an end on this $3,300, $3,400 gold. It's going to break out. I think we're headed towards 4,000, maybe by the end of the year. Silver, once it breaks through 40, it's been hanging out around 38, 37 and a half, 38 and a half. Once it got above 39. But once it clears out 40, it makes a beeline for $50. So you want to get your gold and silver.
The breakout moment for gold and silver may be closer than most people think. Veteran analyst Peter Schiff sees the pieces lining up. Deficits are rising, inflation pressures are lingering, and the Fed is preparing to cut rates, not out of victory, but because the economy and labor market are faltering. July's softer data calmed markets, but the fight back to 2% inflation isn't over. Non-housing services remain strong, wages continue to climb, and a flare-up in energy prices could stall the easing narrative. Schiff points out something more subtle but telling: the way mining stocks now react. When they dip on earnings, buyers are quick to step in. That hasn't been the case for years. To him, it signals that investors no longer fear gold collapsing. Instead, they're positioning for more upside, and that makes both miners and silver stocks compelling. On the price front, gold held firm on Monday as Treasury yields eased. Market players also kept an eye on political headlines, with President Trump set to meet Ukraine's Volodymyr Zelensky and European leaders. Schiff believes the consolidation phase between $3,300 and $3,400 is almost complete. A breakout could launch gold toward $4,000 by year's end. Silver, stuck around $37 to $39, only needs to clear the $40 level before racing toward $50. For Schiff, the key signal isn't just in the metals but in the equities tied to them. Mining stocks are now rising even when gold drifts sideways or slips slightly. That shift in behavior is a break from the past and, in his view, a clear sign that the next leg higher in precious metals is already beginning. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Deficits are going to keep rising, and that is why inflation is going up, because the Fed ultimately is going to cut rates despite inflation getting worse because of the weakness in the labor market and the weakness in the economy. And I think the gold market and the dollar market already smell this. What happened this week? Dollar went down, bonds went down, and gold was down a little bit. Silver was up, right? Gold was down about 0.5% on the week, but silver was up about a third of a percent. Not a big move, but it didn't get killed. It went up. But what was more encouraging to me was the action in the mining stocks, because both the GDX and the GDXJ hit new 52-week highs this week. In fact, the GDXJ hit a new 52-week high on Friday. The GDX didn't do that, but the GDXJ now caught up. It was lagging, and now it's caught up. Both of those indexes are up 65% on the year, right? This is the best performing sector in the Trump economy, are gold and silver mining stocks. Now, you wouldn't know that if you just listened to like a CNBC or something. They barely talk about these stocks, right? They want to talk, let's talk about Bitcoin. Yeah, Bitcoin isn't up anywhere near this much. I mean, it's up maybe 23%. It's not even up as much as gold, but it's getting killed by gold mining stocks, silver mining stocks. Why not talk about those? But, what I was watching this week that was very encouraging is every time a gold stock got sold off on earnings, right, which they've been doing this for years now, whatever the earnings are, just sell, right? That's like the programs are there, the algorithms. Anytime a gold stock comes out with earnings, just sell it, right? Well, they still sold them, but they immediately were bought back, right? The rallies, big drops, 10% drops, come back, right? Maybe it takes a day or two, but the market brings it back because buyers are now waiting in the wings to scoop these stocks up, right? You have big money, sophisticated money. For years and years, Wall Street never had any confidence in the gold rally, continued to expect the price of gold to crash. And so they never bought these stocks, because gold stocks, when you're buying gold stocks, you are buying the future earning stream of these gold mining companies. And if you have no confidence in future earnings because you expect the gold price to crash in the future, well, you're not going to pay up for these stocks. But I think the investors are now starting to come to the conclusion that gold ain't going down. In fact, they're going to have to get used to the fact that it's going to keep going up. And that means these gold stocks and these silver stocks are screaming buys. And that's why the smart money is just finally moving into the market. This has got a long way to go. The public is still asleep. They're not buying these stocks. My clients are obviously, but most of the clients don't get my advice. They don't watch my podcast. They don't have accounts with me. They don't own my funds, and they're not in on this. But again, I continue to strongly recommend. I think the consolidation is coming near an end on this $3,400 gold. It's going to break out. I think we're headed towards 4,000, maybe by the end of the year. Silver, once it breaks through 40, it's been hanging out around 38, 37 and a half, 38 and a half. Once it got above 39, but once it clears out 40, it makes a beeline for $50. So you want to get your gold and silver. People around the world are bringing their money home because it's much better to invest locally in their own stocks that are much cheaper than our stocks and get out of the US dollar, which is a big risk. Even my foreign bond fund is beating the S&P this year. It's up over 10% just buying foreign bonds. And foreigners, when they look at the S&P, they're looking at losses because the S&P is barely up enough to cover what they've lost being in the dollar. And the dollar's decline has really just gotten started. The dollar's got a long way to fall. And so it's going to be a headwind for U.S. stocks and a tailwind for foreign stocks for many, many, many years. So we're getting private money divesting itself of U.S. stocks, investing in foreign stocks. We've got central banks divesting of dollars and buying gold, and that's going to continue. So you've got to do the same thing with your portfolio. Well, everybody else is still, oblivious to what's going on, and they're investing, looking in the rearview mirror, and just trying to do what worked in the past. They have no idea what's going to be working in the future. But what we're doing is forward-looking, and we understand this because we've been waiting for it. We've been forecasting it. It's actually taken longer than I thought for this process to begin, but it's clear that it has, in fact, begun. The reason that my fund is not over 70% is because we got a lot of the real small stocks in there that have weighed us down. But I think that weight is going to become the reason that I believe we're going to outperform significantly. Because I think when more money starts to come into this sector, right now they're focusing on the big names. That's what the big funds are buying because that's where the liquidity is. But at some point, these little ones are going to really start to move, especially when the big ones start buying them. I mean, that's what's going to happen because they've got so much cash now. They're making so much money. They need to expand their reserves. They need to get more gold. And, why spend money exploring for it when you just buy it, right? There's so much in these small exploration companies that have already been looking for gold. A lot of them have pretty good properties they're sitting on, pretty good projects. They just need the money to develop them. Well, these major companies have got nothing but money. They're money machines at this point. Wall Street is just barely starting to catch on. So you really want to load up. This is a great sign that we're seeing this kind of action. I haven't seen this kind of strength in gold stocks in many, many years. Gold stocks are going up on days when gold is down. They used to get killed every time gold went down. Now they're going up, and they go up on days now where gold goes sideways. So you want to get my gold fund, buy some physical gold, and even look at my dividend payers, my basic dividend payers stock fund. I think we're now up 36% on the year. I mean, that's a fantastic return in 1 year. We have utilities in there. We have just basic stocks that pay good dividends, and we're running circles around the S&P 500 or even NASDAQ by buying these stocks because the tide has turned. Money is being sucked out of the U.S. economy, as I've been forecasting.
Gold and mining stocks are no longer trading like they used to. That shift is precisely what Peter Schiff says investors need to pay attention to. While Fed Chair Jerome Powell keeps assuring Congress that the economy is strong and the labor market is solid, the numbers tell a different story. Inflation isn't cooling, it's heating back up. Powell argues against rate cuts due to inflation risks, yet the latest data suggests that rate hikes should be on the table. The July CPI rose 0.2%, holding annual inflation at 2.7%, still well above the Fed's 2% target. Core CPI ticked up to 3.1%. The real jolt came from producer prices. PPI surged 0.9% in a single month, jumping to 3.3% year over year, while core PPI hit 3.7%. To Schiff, that's proof inflation is accelerating, not easing. Markets reacted as expected, with bonds and stocks selling off. What surprised him was the resilience of gold. Instead of sliding on hotter inflation data and the implied risk of higher rates, gold held steady. Even more telling, gold mining stocks rallied. Just months ago, this same setup would have crushed them. Schiff views this as a signal that smart money is beginning to regard gold as a must-own asset in an unstable environment. His broader takeaway is blunt. The US isn't in the kind of boom Powell describes. Schiff calls it a Murphy economy. Everything that can go wrong is going wrong. Growth is weakening, inflation is climbing, and the Fed is boxed in. That leaves gold as one of the few assets showing strength in a landscape where both stocks and bonds look increasingly fragile. Let's get back to the interview.
For all the talk and all the Fed bashing, Powell continues to tell Congress how great the economy is. Powell isn't saying the economy stinks. He's saying it's great. He's saying the labor market is great. So he's, saying the Trump economy is good, right? He just doesn't want to cut rates because he's worried about inflation. And the data we got this week supports the fact that he should be worrying about inflation. In fact, the data that we got this week proves what I've been saying, that the Fed should be hiking, that the conversation should not be about when is the Fed going to cut, but when is the Fed going to hike, because rates are too low. That's why the inflation fire is coming roaring back. Now, before we got the really bad news on producer prices, we got news that the markets actually celebrated on consumer prices. We got the July CPI that came out earlier in the week. And the reason people celebrated is that it wasn't worse than expected, right? That's how low the bar is on inflation. So the consensus was an increase of 0.2, and the increase was 0.2. So not worse than expected. And the year over year increase, which people were worried was going to go up to 2.8, held steady at 2.7. And so that was considered, hey, this is great news. The Fed can cut. Well, why? 2.7, that's 0.7 above 2. The target is 2, not 2.7. When inflation was 1.5 and 1.6, they had rates at 0. They were doing QE because we were so far below 2. Well, at 2.7, we're more above 2 now than we were below 2 then. And at that point, it was an emergency. We needed QE. We needed 0% rates. Oh, my God. We're 0.4 of a percentage point below our target. Well, we're 0.7 above it now. So why are they cutting? Why aren't they equally as vigilant? Oh, we better hike rates. Look, we're way above target, right? And look at the core. The core is even worse. The core rose 0.3, which was expected, but that was worse than the prior month, which was 0.2. So the core is going in the wrong direction, and the year-over-year core, which was expected to come in at 3%, came in at 3.1, which was hotter than the 2.9 from the prior month. So supposedly core CPI is even more important than headline, right? The Fed wants core CPI to be 2%. Well, now it's got a 3 handle on it. What does that mean? The Fed is too easy, right? But somehow the markets looked at this, and because it wasn't even worse, they concluded, aha, this proves that there's no inflation. This proves that the tariffs aren't, being passed on to consumers. So the Fed is all wrong. Powell's a complete idiot and a moron. He should be cutting rates, right? That was the conclusion. So the market celebrated, on that one. But the rug got pulled out from under that celebration when we got the PPI numbers, which were a shocker. They were even worse than what I was expecting. But anyway, so the the number for July was supposed to come out at 0.2, and that would have been hotter than the 0% from the prior month. But instead of 0.2, it came out at 0.9. 0.9, almost 1%, half the whole 2% target in a single month. 0.9 blew away the range. The whole range of estimates was from 0.1 to 0.4. So it's more than double as high as the highest estimate on the street, 0.9. Right? Horrible number, worst in several years, and clearly going in the wrong direction. The year-over-year PPI rose from 2.3 last month to 3.3, a full percentage point higher, and way hotter than the 2.6% that had been expected. And you strip out food and energy, it's just as bad. 0.9, up 0.9, and year over year, get this, year over year, core producer prices up 3.7%. And even more important than the fact that they're up 3.7% is the fact that the prior month they were up 2.6. So not only are we up, but we're moving in the wrong direction. And so this would call for a hikes as far as I'm concerned. So the market got this, and bonds went down, stocks went down. Gold actually shrugged it off. Didn't have much of a move. And gold stocks, and I'll get into that later, gold stocks rallied on the day. I remember a few months ago, gold stocks would have got crushed on a day like this because, it means we're not going to get the rate cuts. We're going to get rate hikes, although nobody talks about the fact that we're going to get rate hikes. But the bottom line is everything that could go wrong is going wrong, right? It's the Murphy economy, right? It's not the booming economy. It's not the golden age. It's the Murphy law economy where everything that could go wrong is going wrong. We're getting weaker economic growth. We're getting a weaker jobs market, yet we're getting stronger inflation. That's going to get even stronger. And it's not just the tariffs. Yes, the tariffs are going to get factored in. I'm going to talk about that. But there's a lot of other reasons that inflation is going to manifest itself in significantly higher consumer prices. But producer prices are a leading indicator of consumer prices. And the same thing happened when we got that big breakout of inflation in 2021. And I talked about it when the Fed was saying nothing to worry about, it's transitory. It started in producer prices. They moved up first. Well, obviously, the producers get hit first with the increase in the prices because, they're buying all the material and paying all the wages and all that stuff. So they get hit first with the higher prices, and then they raise their prices to make up for it. And so the consumers are next. And so this is a leading indicator for a rising CPI. Now, what would a normal Fed do looking at these indicators? Raise rates. The rates are too low. Yet Powell can't even talk about that because he's being threatened to be fired or he's being called a moron for not cutting rates. So they're not even going to consider raising rates, which is why this is bullish for gold and bearish for the dollar. Because if the Fed's not hiking rates when it should be, it means it's too easy. Rates are too low, and so inflation is going to get worse. That's bad for the dollar. That's bad for bonds. That's good for gold. The budget deficit for July was the second worst July budget deficit in history. So it is a bigger deficit in July than every July that Biden was president, save 1 month, 2021. Now, why did we have such a big deficit in 2021 in July? Because of the COVID stimulus spending. That's why, right? Whatever that initial big bill maybe it was the Inflation Reduction Act, whatever the hell they did, but they justified all this government spending because, we still had COVID, we were still locked down or whatever. But that was going on. So in that context, we had a big deficit in July. But every other July where Biden was president, the deficits were lower than this July when Trump is president. Now, when you have a strong economy, what normally happens is the deficits go down. See, what happens in a strong economy? Businesses are doing better. They're expanding. They're hiring more people. And those people are paying more taxes. the businesses are making more profits. They're paying more taxes. And because more people are getting hired, fewer people are getting government benefits, right? So in a good economy, tax revenues should be going up, government spending maybe not as much, and so you should have smaller deficits. When you have bigger deficits is when you have a weaker economy. And I believe the economy today is actually weaker than it was under Biden.
What makes this moment different is the way precious metals are now behaving against the backdrop of conflicting signals. Economic data continues to flash warnings, inflationary pressures that refuse to fade, a labor market losing its edge, and policymakers caught between the need to cool prices and the risk of breaking growth altogether. Yet, instead of retreating, gold is holding its ground, and mining equities are advancing, even when the broader market stumbles. That shift hints at a deeper revaluation underway, not just of metal prices, but of their role within a system that is losing faith in traditional anchors, such as bonds and central bank assurances. Silver, too, stands poised on the edge of a potential breakout, suggesting that both metals may soon reclaim a level of influence unseen in decades. If this trend accelerates, it won't simply be about short-term trading gains, but about a fundamental shift in how wealth and stability are perceived in global markets. Is the current resilience in gold and silver a prelude to a structural turning point where hard assets begin replacing financial promises as the foundation of trust in the economy? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Additionally, if you are interested in Bitcoin-related news, consider subscribing to our other channel for more updates. Thank you for the support, and I hope you enjoy the video.